Hit it.
It's July 3rd, 2026, episode 295. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, Guenter Grimm from Grimm's Global Macro Aggregator, GGMA, joins us to talk about his career in London and Switzerland in fixed income and FX. He shares with us his views about the new Fed chair, Kevin Warsh, and why the short-term and long-term inflation risks are almost mirror opposites. Oh, and yes, we do talk about gold too. Then Patrick takes a moment to get out of the Mediterranean to tell us what he thinks about markets and talking charts. And folks, Patrick and his crew have been busy making a free Commitment of Traders web report that you don't want to miss. Make sure you go to caughtsignal.com.
Absolutely. You know what, Kev, super excited about this new website. We'll talk about it during the talking charts segment, and we'll use it and go through what is there. But it's just, we looked at a brand new way of looking at COT reports just to reframe it so that it's so easy to use. And so just, it's completely free. Anyone, check it out, caughtsignal.com. All right, so I'm gonna drink a beer during this session because it's hot outside, and you're doing the Estrella or Estrella, which beer out here in Spain. So cheers, everyone. Danny, are you gonna have a beer with me here, or are you leaving me solo?
Fresh water for me.
All right. Well, listen, Kev, give us a disclaimer, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the risk asset fatigue disorder, the Cosby correction complex, or the semiconductor hangover syndrome.
Yes, those are very appropriate for this. All right, let's get to the guest.
It's our great pleasure to welcome to the show today Dr. Guenter Grimm. Dr. Guenter Grimm is the founder and CEO of Grimm's Global Macro Aggregator, GGMA, a Zurich-based market intelligence firm he founded in 2025. He brings over 30 years of FICC markets experience, having held senior strategy, portfolio management, and institutional sales roles at Goldman Sachs, JP Morgan, UBS, Credit Suisse, and other leading institutions across London, Munich, and Zurich. At Goldman Sachs, he was part of the currency team managing over US $30 billion in assets for a fund ranked number one by the Financial Times in 2001. He has authored widely followed publications, including the UBS and Credit Suisse Macro Daily. A Swiss-German dual national, Dr. Grimm holds a PhD in economics from the University of Munster. I said that right? Munster?
Yeah.
And is the CFA charter holder. He brings a data-driven continental European lens to global macro. Guenter, thank you for joining us today.
Kevin, thank you so much for having me.
I'm looking forward to this. You have very much a different background than many of our guests. And I would just love to know your life trajectory, like how you got here. Where did you grow up? Did you always know you wanted to be like a currency macro strategist? Like how did we get here?
Let me just try to give you a brief summary. So I did my army service, started in the bank. And as you said, at that time, at 18, I had no clue what I wanted to do. So I had a bit of time to think about it. And then within this bank apprenticeship, I learned about different sides of banking. So this corporate side, and then analyzing balance sheets, blah, blah, blah. And then I was in the markets division. And that's where I learned that my passion is probably more in markets. So I studied economics and then had the chance to do a PhD. My father said I want to avoid work, which was partly right. But so I started very late. I think what distinguishes me from others maybe that I started working when I was 30, which is
wow.
But I didn't waste any time, to be fair. At the time, you went 2 years to the army, 2 years apprenticeship. You studied 5 years. And anyway, so and then I started as a FX strategist at a Bavarian bank, Hypofinance Bank, which is now UniCredito, and then had the chance to get a job at Goldman's Asset Management.
Right. Okay.
As a currency manager, and that was really fantastic.
What year would that have been? Like, when did you join Goldman?
That was in London. And I joined October 98 when the yen carry trade blew up. I will never forget. My boss, Arne Hassel, lovely guy, he was asking me, I just started really, and 1st of October. And then they said, Guenter, what do we do? I said, really don't know.
What do you tell people a little bit? Let's just dig into that because that's interesting. So you've grown up, and you mentioned the Army. You have to do 2 years or a couple of years of service. Is that how it
18
works?
months, that was at the time. It was
Okay.
compulsory. Then they shortened it, and then they abandoned it. And now they're thinking about reintroducing it, and first on a voluntary basis. But it was a great time. So I did my high school degree, and then I stopped thinking because I did something completely different, and that was the
Right.
right thing to do. And also, that's what I tell my son, who's now here in Switzerland, has a Swiss passport, goes to the military. The big advantage is, apart from politics, is you get to know other people from different areas
Right.
of society.
Oh.
And that's the only time, I guess, later on you are on track in your own little balloon.
Yeah.
But there you met the butcher's son, everyone, yeah? And then you learn how to have to bond in a difficult situation. You have to stick together.
That's fascinating. I wonder, if more and more countries are going to be doing that in this age of geopolitical tensions. Okay, so you go to Goldman after all of this university. You get plopped in there in terms of, and this is Goldman Asset Management, like the buy side, not the sell side. So you're managing, some sort. Is it a fixed income only? Or is it currency and fixed income? Is that what it is?
So we had various products. So the team was responsible for, we had our own currency fund, and we did the overlay management as well of various other funds. So at Goldman's, and I think that was the right way to do, every fund manager, let's say fixed income or equities, they had to look at it on a hedged basis, and they gave us the currency risk as a team, to then decide, do we hedge or unhedge?
Okay. Yeah. And so you get popped in there, and it's right before, like, as long-term capital coming unglued, I guess, right? In terms of that, explain to us, for folks that don't know that period, what it was like in FX. Tell us, and then you're this young guy that's getting plopped in there. What were the stories like? How did you adapt? Give us some color on that period.
Yeah. So at the time, the carry trade was a massive thing. So various carry strategies. So buying the high yielders, funding it with the low yielders, and everybody was doing it. And then came along the dollar yen trade, blew up. So that was really that was a really, really historic event and left a mark.
When I can't remember how much did the yen move at that period?
I just looked at it. I think around 30% or so over a period of time.
Yeah, like it was huge. We're going to talk about the yen right now because later today, because it is something that we could be maybe experiencing something similar. Okay, so from there, where do you go? Give us the further evolution of your career.
Yeah. So I was really happy. We had a fantastic team, and then they asked me to run fixed income, European fixed income. And I found it interesting, was the right move within my career to also learn more about fixed income. And but then I was lured over to the dark side, the sales side. And it is what it is. But maybe I should have stayed on the buy side, especially at Goldman's. I think it's a fantastic firm, to be fair.
I'm a huge fan of them as well. Especially, I find the London guys really terrific.
Right. It was a bit, it is what it is. And then I started JP Morgan on the sales side, covering.
So you say you call it the dark side, and you didn't like the sell side as much. Explain to us why you didn't like it as much, and for those who might be thinking about it, give them the kind of picture of why you felt like maybe you should have stayed on the buy side.
So initially on the sales side, it was fun, and to be fair, you are a one-man show. Yeah, you build your own business. At the end of the year, you look at the numbers. Did you perform or not? And that there comes the bonus or not. So it was pretty straightforward. But then it became a bit more political, a bit of envy. It's difficult to build up a team. You're never sure if the guy is sitting next to you is after your chair, wanting to cover your clients. And then, of course, came along all these scandals. And it became, the new trend was to go electronic.
Right.
So in the old days, you have an idea. I always wrote my morning commentary. People liked it. And then you had a little chit chat on the phone and talked about markets, maybe ideas. And then he said, okay, you know what? Just buy me a yard of euro dollar. I like it.
Okay.
So I pick up the phone to the trader, both on them. and you had a deal. And everybody was happy. It was win-win. Now you have 20 banks on your panel, and even if you have a good idea, doesn't matter, it's best price. And now it's also all electronically executed. So you only have a salesman there anymore for problems, basically, which land on your desk if something went wrong, confirmation missing. And then I had enough. So I was at JP Morgan, joined UniCredito before the crisis.
Yeah.
They had big plans to expand in Asia. It was a fantastic story. I was heading a team, European Money. I know it's more second, third tier bank at the time. And then comes the crisis.
Yeah.
We had our two twins. UniCredito was about to almost go bust, but so was every other bank. Then Royal Bank of Scotland, believe it or not, came along. And there were two Germans covering German clients. They had enough. They went back to the fatherland. And so they desperately needed a German salesperson. So I went into the seat and started covering Swiss clients.
Oh, okay.
And that was monumental. So I came then to Switzerland, visited them, very nice, very welcoming. And then I came out of the airport or the train station. I said, what's going on here? Everything is so nice. Everything works. People are nice. And then I said to myself, we had twins, as I said, if I have the chance to move to Switzerland, I'm going to take it. And then my ex-colleague from JP Morgan, Richard Longmore, he became head of European Money here at UBS. And I said, Richard, if there's a way, please let me know. And so it was. The seat became available. UBS at the time also was still a bit in trouble, but stabilizing. Then came Quaco, another story. But I was very happy there. Started again as a salesperson, and then migrated a bit into the UBS knowledge network, which was the answer to MiFID.
Okay.
Like a semi research outlet, because at the time, economists or strategists were not allowed to be in Bloomberg chats anymore. There was a scandal, so they were separate. So then we invented this knowledge network and covered still clients with views. And so
I didn't realize, what was the scandal with the Bloomberg chats? Like, I don't even know this story.
Fixing scandals, LIBOR.
Oh, the LIBOR. Okay, I know that one. Okay, yeah.
And then all of a sudden, US said no more, and other banks as well, no more strategists. So that's research that's separated.
Right. Okay. And so then you're moved to Switzerland. You're having a great life. And what have you done since then there in Switzerland?
So then I was doing this knowledge network stuff, but then of course I was a cost center. I had no P&L anymore. I was over 50, so I was made restructured.
Right.
Politer ways of saying you're fired. And then I had the chance to join Credit Suisse as a trading strategist.
Okay.
And I loved it. I was between the sales guys, the traders. I was seeing clients, telling my stories, our stories. Sharp Jalinos was my boss, fantastic guy as well.
Yeah.
Can only highly recommend him, read his stuff. And but then we know the story, Credit Suisse went bust.
Yeah.
And then I decided I want to do it on my own.
And so since then you've been running your firm.
Yeah.
This
was always in the back of my mind. Yeah.
And so what year did that start?
So 25. So last November.
It's brand new. It's brand new.
It's brand new. Yeah.
Okay. So
I always had the plan.
Yeah.
Because I was writing these morning comments.
Yeah.
I wanted to have a website, build it for 7 years on the side as a hobby.
Right.
Made a pitch. It was never live. Said, Guenter, nice idea, but you need an app. And then I took a big breath, mothballed the website, and started developing the app since April last year.
Oh, that's awesome. That's terrific. Yeah. Before we get off your history, I think I read when I was going through your bio that you did machine learning when you were at school.
Yes. So
I would love to kind of, because that must have been a fairly long time ago.
Yeah, and people who know me must laugh because so during my master's studies, you have to write a diploma thesis.
Okay.
And the assistant said, "Okay, you like currencies? It looks like let's write about something interesting. It was, I think, currency forecasting and speculation. And then along my studies, I came along this software from Siemens.
Okay.
It's called SENN, Software Environment for Neural Networks. I had no clue. I'm really bad at math. I can't program. And then I finished my master's, but I always had this idea in mind, maybe write a PhD about using that software to predict currencies. And at the time, it was a big hype, right? AI was in everybody's mind, like now, which reminds me of that period. So I finished my master and then went to my professor who liked me and I liked him and said, can I do an external PhD? Normally you work for the doctor for 5 years or so. He said, yeah, you can be my assistant for 10 months. We have a little budget. And then I went off to Munich where Siemens was, and they were so kind to let me do the calculations using their software. And to be fair, I had no idea what this was all about.
Right.
But I put in my numbers. The idea was to test historical exchange rate models, the various theories, what you should use as an input. So I did that, and then did the math and compared it to a standard linear regression model.
Right.
And then I learned what's going on in this neural network, the positives, the pitfalls, and so on. And that was really fantastic time. And at the same time, I financed it with working in the research department of High Performance Bank.
Okay.
For 2 days.
We'll talk more about AI when we get to your market views here. Okay, let's start with the Fed.
Yeah.
Because I think the Fed is interesting in that I don't know about you, but I talk to my my equity-based kind of trader buddies, and they're all coming up with these theories about why the Fed is really dovish and Warsh is going to lower rates and all this stuff. And then I talk to my fixed income trader buddies or my STIR buddies, and they're all saying, oh man, that was the most hawkish Fed we've ever seen in terms of the recent press conference. I view this probably as one of the more transformational Feds that we've ever seen, and that this is a huge point. And I think that there's a lot of uncertainty about what this really means when Warsh says different things. So why don't you walk through how you're interpreting what he's saying and what it might mean for markets going forward?
Yeah, and I think it's worth remembering before Warsh started the setup. So the setup was, as you said, he's a Trump appointee. Trump wants lower interest rates. We know that. And therefore, I guess the bias was, okay, he can't be that hawkish.
Right.
Then we had the start of the Iran war, the oil price spike, higher inflation numbers, other central banks like the ECB front running the hike. But still people, I think, went into this first Fed meeting with a dovish bias, probably looking at the price action also positioned that way. And then came along Warsh. But with hindsight, I think it all makes sense. Hairy hindsight, of course. Because so he wanted to, he has some hawkish credentials, but the goal is really to lower interest rates along the road. And how do you do that? You sound hawkish and hope that the market buys it, which it did. 2 years spiked, the curve flattened. And so the long end was in check a bit. And inflation expectations, because in the meantime, we had the Iran ceasefire negotiations, oil prices coming down gently, break even inflation rates also coming down. So it's all working for him now at the moment.
Okay.
So a friend of mine told me, well, he's still a dove, maybe in hawk's claws. We'll have to see. The fact is that he has set up now these commissions, and we have to wait for the outcome. He doesn't give forward guidance, which I think is not a bad thing.
Okay.
It means market participants have to do their own homework now, have to try to forecast the labor market and CPI, I guess those are the main variables. And the economy, of course. And so it's going to be interesting. Some say that could increase volatility, but as Warsh also mentioned, since he took over, yields have come down, although they have spiked up higher again, and volatility in the bond market has also come down. Stocks, I think, have taken it very well. But it will be now, so I would say talk is cheap, but now we have to see meeting from meeting. There's some rate hikes priced in, how that develops. If we will validate those expectations and hike rates really, or if he then says, listen, in the meantime, the oil price has come down, the inflation outlook has improved. The last labor market report was a Goldilocks report, in my view. So no inflationary concerns. And I think my gut feeling is he won't hike.
Okay.
That's a big bet.
Right. One of the things you mentioned there is that he's going to take away forward guidance.
Yeah.
In the modern history of the Federal Reserve, we've never seen a Fed go and do a cut or a hike that wasn't fully priced in like 3 days before the cut.
Yeah.
Right. Do you think that's changed? Do you think we could have a situation where we have a 20% chance of a either way, a hike or cut, and then they actually do it? And if so, how does that not mean higher, an uncertainty premium that needs to be priced into the front end of the curve?
Yeah, you have a very good point there. So at the moment, volatility has come down a bit, but I agree. And he said, listen, we have a family fight in this room, and then we come out and tell you our decision. So yeah, I think you're absolutely right. And therefore, the market pricing is what it is, like, let's say, call it 50-50. And I think this could be the norm going forward.
Yeah, and I think that the market hasn't really appreciated how little they're going to get spoon-fed. And if they're not going to get spoon-fed, like, it means that they have to surprise markets. I really truly believe that. I'm kind of confused. What's interesting is that, I was talking to a pod shop buddy, macro buddy, about this the other day, and we were chatting about whether that truly means more volatility or less in terms of the market. And one of the things, though, that I remember is Bank of Canada Governor Poloz did this once. He surprised the market with a cut or a hike. I can't remember which way it was. And he said, it's important that I just introduce some uncertainty to the market. It didn't seem to affect the markets back then. So maybe we're overstating, like, in the reality is, like, if they surprise with one cut or one hike, in the grand scheme of things, does it really matter? Like, they'll fix it the next one, or like, maybe we as market participants are too attuned to it. And this is part of Warsh saying, let's step back and think about the longer term horizon. And maybe it does, lower volatility from a longer term perspective. Do you have any thoughts about that?
Yeah, maybe one should then just think out loud here, distinguish between the short end and the long end. So maybe a surprise hike is, yes, of course, very could lead to some short-term volatility, but it could calm down the long end. And I think the long end at the moment in general, not just in the US, but everywhere, especially in Japan, we come to that, is very important. You want to keep the long end in check and don't lose the long end. And if it means maybe a rate hike in the short term, so be it. So it could increase volatility in the short term, but maybe reduce it in the long term. Yeah.
Okay, let's talk about that long end in terms of the US. And I don't think people, like, especially non-fixed income people, don't appreciate how much the long end is sensitive to whether the Fed is overly dovish or overly hot. I mean, overly dovish in essence. And I think we were on the cusp of the market of the long end being scared that the Fed was going to be actually under a Trump puppet. And by going and saying, no, I am my own person, price stability is what matters, he anchored the long end. Talk to me about the response about the long end in Warsh. And then you mentioned something about him, maybe he's just talking dovish to calm down the long end, and also inflation swaps declining. But what if they're declining because he was hawkish? And what if he doesn't actually follow through, whether we'll get the market responding negatively?
Yeah, it's a very good question. I was thinking about that as well, because what we are seeing right now is a re-steepening bit of the curve. We see a weaker dollar. We see rising stocks. So the market was initially surprised by his hawkish response, sort of, and now was kind of relieved because he mentioned at the Sintra conference, when he was on the panel with Bailey, Lagarde, and himself, and they all mentioned energy prices have come down, so maybe we don't have to be that hawkish. And I think the fall in energy prices takes a huge burden of these central banks. And my gut feeling is they don't want to hike. They don't want to rock the boat. I believe in this fiscal dominance theme. And they know what's at stake. If they hike too much, look at Japan, years back, when they hiked too much, it all blew up. So they have this in mind, and therefore they want to pretend a bit they are hawkish, price stability, and so on and so forth. But deep in their heart, they don't want to hike.
And so if they don't hike, do you think that the long end might like go back up in yield? Do you think the long end might be disappointed going forward?
Yeah, could well be.
And one of the things you mentioned there is that they don't want to hike because they remember, like, isn't it Trichet that hiked into? Give us that story and what happened there and what's in the back of their mind when they're thinking about the worries of hiking too much.
So Trichet, as a French central bank governor, now at the helm of the ECB, I think wanted to build up credibility like the good old Bundesbank. And at the time, I remember many smart people said, no, don't hike. It's a mistake. You have to reverse it. And that's exactly what happened. So he hiked, and then, there was a mistake.
I think he hiked twice, didn't he? It wasn't just once.
It could,
I think he hiked twice. And didn't he usher in the European crisis? Like, wasn't that the start
it all came together, didn't it?
Yeah. So when you're thinking about things, the Fed and all these central banks are walking this line in terms of this inflation. Why don't you talk to us a little bit about your view of inflation, the short term versus the long term, and how you see it playing out and what the risks are to both?
So in the short term, my gut feeling, and I'm not an oil expert, but I read what everybody else reads. But if I put one and one together, I think the main policymakers, the US and the Iranians, they want lower oil prices. The US, because Trump has the midterm elections, he wants to win, and therefore needs lower oil prices at the pump, gasoline prices. And the Iranians are desperate for money. And the other OPEC members, they also need now cash to rebuild everything what was damaged. And so I think, how likely is it that the war resumes? I put a rather low probability to that. Famous last words, heading into the midterms.
Yeah.
What happens then is maybe different. But so my gut feeling is we might now undershoot. Because remember, when this war broke out, a lot of, to be honest, smart oil analysts said, okay, this is apocalyptic. We're heading into $150, $200 scenario. This is really bad, which it would be. But it never really materialized. And special factors like the Chinese not importing, but running down their reserves, and the US as well. And so it didn't turn out as bad. But I think a lot of people were positioned for higher oil prices. So now maybe the pendulum swings back. And maybe we undershoot. If I look at the charts, low 50s is not impossible. I still have this oil glut during the COVID crisis in mind. I mean, that was COVID, of course, to a completely different situation, but why not low 20s, 10s? Right. But there will be a floor because all these major oil players, countries have to rebuild their oil inventories.
Right.
Again. So there will be a floor. Is it 30? Is it 40? I really don't know. But at the moment, my bias is lower oil prices. That will feed into lower headline inflation, hopefully also into lower core inflation, and therefore will relieve the central banks. So
when we see that in like the inflation swap market, you'll see the 1 year inflation swap has fallen over the last couple of months from 320 to 220.
Yes.
So the market is completely agreeing with you. So you're seeing this, and that's why you think the Fed might be willing, the Fed, not just the Fed, all central banks might be willing to wait out a period of higher inflation.
And worth mentioning, I love looking at real yields and the expected inflation rate.
Okay.
And if you look at real yields, I just checked, they have been climbing and now stabilizing in the US, but at relatively high levels. So the 10-year is just above 2%, 30-year is at 280 or so in real terms. Right. So there's a bit of passive tightening going on.
Right.
Doing the job
Understood.
already.
Why don't you explain to people that may not know what real yields are? Like, that explain.
Yeah, sure. So you have the nominal yield, and you can break that down into a real yield. In theory, that's a theoretical concept. And then the expected inflation rate, and one should also mention maybe credit risk premia, but let's ignore that for the time being. And there's a market for that. In the US, it's called the TIPS market, so you can trade these securities. So if you have a view on inflation, you can express that in the TIPS market. Right. And I look at it all the time. And for an economist like me, it's a great concept, because the real yield should be driven by growth, and then, of course, central bank policy, fiscal policy, I think, also plays a role. And then you have inflation. At the moment, it's mainly driven by oil inflation, energy inflation, but other factors as well. So if you have a view, you can express it there. And I look at it, of course, if you see rising real yields and falling inflation rates, maybe that's positive for that currency, but maybe not so good for the stock market, because falling inflation rates mean maybe less earnings, but that's a different story. So yeah, I think it's a very, very important indicator for me.
Okay, so you have this view on the short end of the inflation market is, we could have a 6 months, a year or of declining, at least the rate of change of inflation will be lower. What do you feel in terms of the longer term risks to the markets and to the economy in terms of inflation?
Yeah, so I came across this book from Charles Goodhart, and again, I'm an economist. I love central bankers. And he was at the Bank of England. He's an economics professor, I think very intelligent. And he came up with this book, and I think he republished it, updated it, and made, I think, very sound arguments why inflation might be on a long-term upward trajectory. One is demography, so shrinking workforces, putting up upward pressure on wage inflation. In that light, also, China, as we all know, manufactured a lot of cheap manufactured goods based on cheap wages in China. So we had this deflationary China shock, which might be reversing. We had globalization. Now we have deglobalization, and I really believe it. Everybody has forgotten about these tariffs, but it's still happening. Right. And that should be inflationary. And then, demography I mentioned. We have higher real yields because of fiscal deficits, and fiscal dominance plays into that. And the central banks now afraid of potentially hiking less than they should, and fueling this inflation as well.
Right. And so if you put all these together and you think about what you are forecasting in terms of inflation over the long run, you think it's going to continue to surprise to the upside? That although we had this spike in 2022, a lot of folks argue with, it's just COVID, it was just supply side, it wasn't really anything different. We're going to go back to 2% and sub 2, and we're going to return to the 90s to 2010s or 2020s. But you're in Charles' book, a camp, that this is that the anomaly was lower inflation before, not now.
Yeah, I agree. And unless we see a severe recession, depression, I think we are on a gentle upward trend in inflation. I'm not calling for hyperinflation, although I'm German. But
you're not calling for it, but you're worried about it.
Yeah, I am. That's the first thing I taught my children. They will laugh, but they are witnesses. Because my father did the same. It's ingrained. It's ingrained.
It's just pass it along like it's like a tale that you have to indoctrinate each person with this worry about inflation.
Yes.
Like, you got to be worried about inflation.
Yeah, I wish I would be Italian, but so it is what it is, and so I think 3% is maybe the new 2%.
Okay. But see, one of my problems with this, and I'm willing to buy that. I completely understand, and I didn't know this book. By the way, for those who want to go buy this book, It's called The Great Demographic Reversal, Aging Societies, Waning Inequality, and an Inflation Revival by Goodhart and Pradham. And it was published in 2020, I believe, or in 2019, somewhere around there. I'm embarrassed to say I haven't read it. I'm going to go, order it right after we get off here and go read it. But one of my kind of problems with this is, okay, so we know inflation's going lower in terms of over the short run, but we've just made the case that inflation is headed higher over the long run. And I think you could actually very credibly make that case, because if we look at the reality is that Warsh has said a couple of times, or not even a couple of times, many times, the Fed hasn't hit its target since 2021. It's been a long time. The world has changed. But yet he continued to say, we are going to deliver price stability. And I think when he says that, to me, he's saying he's going to get to 2%. And I thought it was funny that a lot of people listen to him talk, because in the past he had talked about the left-hand side of the decimal and the right-hand side of the decimal. And if you listen specifically to him in the FOMC press conference, he said, no, that it's a 2 and it's a 0. And he was very clear about that. How do they get back to 2 if we're faced with this, secular upturn in inflation? And see, that's my problem. And isn't inherent in that the chance that Warsh is going to over tighten? Like, isn't he going to make the mistake?
You're absolutely right. And I also thought about it. And because you also mentioned financial conditions, but in different sectors.
Okay.
So for the housing sector, he said, for example, well, it's rather tight because you have high mortgage rates and there's stress maybe. But then he looked at stock markets. You look at stock markets, credit markets, their financial conditions are really very favorable for growth. And then at the same time, we have this K-shaped economy where wealthy individuals have a higher propensity to spend.
Yeah.
So I was thinking, how do you square the circle? Maybe by reducing or introducing a negative wealth effect, by trying to maybe engineer the stock market a bit lower. And that was the initial reaction. I'm not sure yet how. Maybe the balance sheet, but then he was also defensive there.
But okay, I think the balance sheet is a great point. I was going to bring that up, because I think if you listen closely to his comments in Sintra, he implied that the balance sheet created like financial wealth instead of real economic wealth. And I kind of, if you read between the lines, it seems to me that he really truly doesn't like the large balance sheet. He does think that it's the problem with inequality. And then the question is, if that is the case, is he going to be able to convince the FOMC to, abandon abundant reserves and move back to scarce reserves? What do you think?
So he said, because I remember initially when his name came up as a Fed governor, the market was a bit scared, because also of his view on the regarding the balance sheet. And then it became more clear that he becomes a Fed chair, and the market wobbled again. And then he backtracked a bit and said, listen, and he did the same at Sintra. He said, basically, it took us 18 years to come up with this huge balance sheet. Right. We can't just reduce it within, I don't know, a couple of weeks.
18 weeks, I think he said. It can't be fixed in 18 weeks.
Yeah. So he will be very careful, I guess. But yeah, you're absolutely right. He doesn't like a big balance sheet. And I also wonder, why does, like the Bank of Japan brings back to Japan, why do they buy equities? Why do they buy bonds, mortgage bonds? Are they still
buying?
The Japanese are still buying government bonds. Yeah. They just reduced the tapering. Yeah.
Oh, I didn't know that.
Think about the signal. It's the balance sheet. I wanted to look at the balance sheet contracts year over year.
Yeah.
But they're still buying JGBs. And I have to look into the exact numbers. But it's a fact.
Okay, so let's go to Japan, because
my pain trade.
Well, it's my pain trade too. So first of all, like, do you remember a period when on a purchasing power basis that, currencies were this cheap? Like, you go to Japan and, it is just dirt cheap, right? Like, and it's only like, I went a couple of years ago and it was dirt cheap, and it's only gotten cheaper. So they're gonna they're gonna raise their rates just because they're fed up of all the tourists coming. Um, so what's going on? What's going on there? Explain to folks what's happening and what your views are, and whether you think that what it'll take to fix this.
Yeah. So we have to make a distinction between the goods market, which is what purchasing power parity is all about, and then the capital flow market. So, and as we know, the capital goods market traded on the exchanges is rather small compared to, so it must be capital flows.
Right.
And so why is capital fleeing Japan? I think there are many good reasons: high debt, low real interest rates,
Okay.
the central bank, which is really behind the curve. I mean, what they're doing, I don't know, but they are scared that they repeat the same mistake they did years back. And
I'll explain to people what that mistake was and why they're scared of it.
I can tell you my anecdote. So I mentioned my bank apprenticeship, and I was in this financial markets department, and there was this poor guy coming in every morning, bought the Nikkei at the time, I think it was around 40,000. And it kept falling and falling and falling. And just a year ago or so, this guy would have made his money back. So 40 years later.
He would have gotten even.
People say, oh, no, stocks, you have to buy stocks. It always goes up.
Yeah.
Well, have a look at some markets. It doesn't always go up. Yeah. And so why is the yen so weak? It has to be capital outflows. Also, when there was intervention or not, or verbal intervention, it dipped and then immediately came back.
Right.
So these dip buyers. So the real interest rate differential is a problem, and put positive for the dollar. So the question is, how can that reverse? So we need, I guess, a US recession. I'm not predicting that. Maybe slow down, but yeah, at the moment, and then now with Warsh, potential hawkish Fed share. So that helps or keeps a bit in dollar yen. At the same time, it causes a lot of problems for the Japanese bond market, the JGB market. And we see that the long end wants to go higher. And then if they let dollar
higher
yen,
yield,
yes, absolutely. So if they let dollar yen go, you have higher imported inflation. Inflation expectations are now above 2% in Japan even. Yeah, correct. But real yields are also climbing higher, but still below US levels.
But isn't the solution to their problem the GPIF, like getting told that instead of owning 25% of your foreign exchange, your fixed income in foreign bonds, that you bring back 10% of that or 20% of that, something?
That's their secret weapon. Because you hear also now apocalyptic forecast of $200 in dollar yen. I mean, everything is possible. I'm not ruling that out. But before we get there,
like $200 oil.
But before we get there, I think they can pull a lot of other levers, as you said.
Right. And so what do you is it politics? Is it a lack of kind of leadership? Like what's stopping them from doing what's needed?
The PM doesn't want a too strong yen.
Oh, you think she actually wants this?
And she appointed 2 dovish members to the board. One the other retire. So one has, I think, now joined. But he made okay comments, neutral comments, not that dovish, the new board governor. But I think inherently she doesn't want a too strong yen.
So she's worried about the mistake they made previously. And that's, by the way, that same mistake about letting the currency rise is what's kept China from raising their currency rate as well.
She has her growth agenda. And those plans are very expensive from a fiscal point of view.
But then from a fiscal point of view, that would be further credence to my theory that you should bring back the GPIF so that you can fund that.
Yeah, but first, I think you have to let interest rates rise to make it attractive. But I think on a hedge basis, it is already attractive to rather invest in Japan than in the US. But I have to double check. But yeah, ideally, you need higher interest rates, higher than in the US, of course. Is it realistic at the moment? No, they're at snail's pace. They're talking about another hike in December of 25 basis points. We are now at 1%, I believe. So yeah,
So are you a long-suffering Japanese yen long like me?
Yes,
Yeah.
and bleeding every day because of the carry.
Yeah.
But I have this memory in my mind that dollar yen can also move very, very violently to the downside, and don't want to miss out. By the time I throw the towel, you can probably go short already.
That's what I tell everyone. I'm like, oh no,
Yeah.
you're because I still own it.
But here's my hedge potentially. I also think euro yen or Swiss yen is too high, too expensive. And you have a bit of a policy divergence here. You have this SMB, for example, but I've been saying that for a long time, and this is not investment advice, of course. But you have now an SMB, inflation is rather low, which is firmly on hold and potentially would cut if franc would go too strong and intervene. So there's a bit of a floor in Euro Swiss say. And then you have the BOJ, which is slowly but steadily increasing rates. So here yields are 0% policy rate. And in Japan, they will probably climb to 1.5 or 2 even in a year's time. So the carry slowly but steadily moves in favor of the yen in nominal terms. Inflation is higher in Japan, so that would, in real terms, then you end up at zero, let's say, if inflation is at 2%, nominal at 2%. But the trend, I think, is your friend in this case. But you have to be very, very patient.
I was just pulling up the chart for the Swiss yen cross rate, and it's actually gone sideways since 2026. It is not.
Yeah.
It has stopped rising. Like it had a big move in 2025, but it almost looks like it might be topping.
Yeah, it's almost a victory for us.
We only lost the carry. That's all we lost. Speaking of FX markets, that's obviously your specialty. One of my terrible calls, apart from the yen, has been that I thought FX vol would rise, and my theory was that Trump was, although he talked about a stronger dollar, in his heart of hearts, he actually wants a weaker dollar. And I thought we would have more disputes, and we would have Trump saying your currency is too strong, pushing things around, and it's been an absolute dud of a call. It's probably been my worst call that FX vol would rise. It's been, we've seen fixed income vol rise, we've seen stock market vol rise at different times, we've seen precious metal vol rise, obviously, but yet FX vol sucked. Why is that? And do you think that is just the new way of the world, or do you think we will return to a world where FX is actually exciting again?
I wish, but all these, for me, the currency rate mostly, not everything, but mostly reflects monetary policy.
Okay.
And at the moment, they are all a bit in sync. Sometimes one central bank deviates by maybe 25, 50 basis points, and then the other follows. But you don't have a policy divergence where you can make the case, okay, the US now needs higher rates, 5%, say, Fed funds, and you have a slowdown in Europe, and they need to lower rates. That would be a clear case of, I would say, well, that's very positive for the dollar, bad for the euro. I don't find these scenarios very often these days.
And okay, but why is that? Because wouldn't you argue that in this day of tariffs and a deglobalization, that we should actually be having more divergence in the underlying fundamental economies?
That could very well be, but probably it takes a bit of time.
Okay.
Because these things change slowly. But it's a very good point you made. Yeah.
Okay. While we're talking about FX, let's move over to our favorite thing that you have, obviously, as a Swiss German, will love talking about: gold. One of the things that I think is interesting is that one of my theories was that in 2022, when Russia invaded Ukraine, a lot of the folks that had their dual regression models between real rates and US dollar versus gold, they were all sitting around. Some of my biggest gold buddies were sitting around waiting to buy gold lower. And I kept saying, nope, the world's changed, and the People's Bank of China buying will change things. That worked for a couple of years. My theory that you should throw that model away. Having said that, I think that this last, maybe 6 months has seen a return of that model. what's your theory? I mean, what's your view on that? So of gold versus the US dollar and real rates and the People's Bank of China, just square all this in terms of how you're thinking about it.
Yeah, I think the reason why gold and at the time also Bitcoin had these phases rose, it was people lost confidence in central banks.
Okay.
Lost confidence that they really mean it when they talk about 2% inflation. And you mentioned how many years the Fed has missed and the ECB and how they missed this COVID shock and Japan. And so, and I think there is an argument that is still valid in the long run, that central banks will underdeliver, coming back to Gotthard.
Okay.
Basically keeping real yields too low, long term. And also the other big factor, I think, which will support gold in the long run is central banks buying gold instead of dollars. So a bit of so less dollar reserves.
Right.
Having had this experience with the Russian reserves, which got confiscated, which I think was the right way to do, by the way, but it leaves a scar. And so less trust in the dollar maybe. But where else do you go? Do you then buy the euro? Not sure. Do you buy the yen? Do you buy the yuan? So there's gold. And Bitcoin hasn't really fulfilled this role, looking at the price action there. So I think gold should be in everybody's portfolio, depends on the share. I really see gold as a hedge if something really bad happens, where you can't go to the ATM anymore with your credit card. And you want to have gold nuggets in your little safe down there to go to the butcher. And hyperinflation.
Do you think we've seen the bottom in this recent move?
My short term, because of my Fed view, I could see it rebounding, and then we really have to watch Warsh's first rate decision, or the next rate decision.
Okay, so to that point, you are of the belief that real rates and the US dollar and the traditional metrics of what drives gold prices is going to return for the short run.
Could well be, yeah. I think real yields have risen. The dollar has benefited from that, and gold probably has suffered because of that. So short term, yes. The long term bullish gold factors, I think, are still in play.
Okay, let's finish up with the political risk in terms of the U.S. midterms. What do you see happening there, and what does it mean for portfolios?
I'm, of course, not a U.S. political expert, but again, if I read the press, I see a general tendency for, because of this income inequality, which is happening not just in the US, but everywhere, that the political pendulum swings from one extreme to the other. There's no middle ground anymore. And now we had Trump. People are a bit frustrated with inflation too high, and the economy, for some, not doing as expected and as promised. So I see the risk now that something like what happened in New York with the allegedly socialist mayor, now happens a bit in the midterms as well. So a shift to more left-leaning, very liberal Democrats. And I'm not sure. So it will paralyze Trump's policy agenda, I think.
Okay.
And then, of course, it also increases the risk that the next president will be 2 years later coming from the Democrats, and maybe not a moderate Democratic candidate, but a more even left-leaning candidate. And I'm not taking sides. I can see why this is happening. But it's just, I have to look at it from
you talk about what's going to happen as opposed to what you want to happen. What do you think that means to the markets though? And
it should be negative.
Right. But you'd think that they would see that already, right? That's what I struggle with. But yet I go and look at what's priced into the S&P. Like you can look at the forward implied volatility.
Yeah.
And there doesn't seem to be any worry about it. And I actually think that that's a trade. I'm going to write that up shortly. But I'm with you. I look at the upcoming midterms, and I think that there's a lot of risk. And I think that would be the best outcome, is that it leans a little left and everything goes well. There's some cases to be made that there's something worse that happens.
Tax policy.
Well, tax policy is also, a worry that there's political uncertainty. The elections don't get certified. There's an uncertainty that there's political, discord. It just ends up being that I'm shocked the markets aren't more worried about it.
I'm with you. Absolutely.
Well, listen, this is not very good. You and I, we're wrong on the yen. We're going to be wrong on this. Okay, listen, actually, I'll ask you one last question in terms of before we get off the markets. I've asked you a lot of different things. If you were interviewing yourself, what would be kind of the maybe something that we've missed that you would think that is important that you would want to talk to people about in terms of your market views?
Yeah. So I'm very interested in history, economic history, and sorry, that's the cat. And I wonder what would it need to get us into a big depression? Yeah. So why is it now so easy to avoid this depression? And what were the signposts when we were heading into the big depression? So I'm going to follow this theme to see what must happen that we could end up in such a scenario, which would be really bad. And it's not my forecast, but I want to be mentally prepared that if it happens, I want to be early and not too late.
I think that's a great point. And I was laughing with someone the other day because I was saying, remember back to 2023 when we had a situation where the most professional forecasters in terms of their forecast for the next year were the most bearish on the economy that they'd ever been in the history of that Fed data for the past 50 years or something like that. And yet the recession didn't come. Now we go and we look at it, it's just the opposite. Nobody's talking about recession. It's like we've thrown them away. Right?
Yes.
No, like tell me somebody that thinks we can have a recession again.
Yeah, it has to do with fiscal and the bond market not rebelling.
Okay, so
is not tame.
You mentioned fiscal a couple of times, and I'm actually a big believer that the fiscal is the most important part that people have missed time and time again.
Yeah.
And one of the things that I believe is that 2020 brought in this era of fiscal, dominance, or at least introduction of reintroduction of it. Do you think that fiscal is going to continue until the bond market, takes away the keys, as Bill Fleckenstein says?
Absolutely. So at the moment, politicians have this feeling, whenever there's a slight problem, you just throw more money at it. And the bond market doesn't punish them. Well, I think the bond investors should wake up, but they're all stuck in their benchmark, and you have to have 60% in long-term. I don't know. Maybe that's the reason. So this passive investment strategy forces them to buy bonds automatically without thinking, what the hell am I doing here? So I would be short duration, long-term.
I got it. I'm with you. I hear you. It's tough. But the trouble is that if you, from a cyclical point of view, it's easy to make the case that there's a lot of, optimism priced in, and we might actually get a rolling over of the economy. But anyways, that's some terrific stuff. Let's talk about your product now. You mentioned that you started this in the last year. Tell us about it. Why you started it, what it is, and how people can learn more about it.
Yeah, so I mentioned that I was on the buy sales side, and I always wanted to have information really in a very nice, digestible way, also with a short attention span. So I wrote my morning comments, and the biggest compliment I ever got was from a big hedge fund guy. Said, Guenter, I read your morning brief, the only one, and I know 99% of the main stories, which I need to read, are in there, because he gets 20 of these emails. And then I thought, okay, I built this website on the side, never went live as a hobby for Plan B, and made a pitch. And then this guy said, it's nice, but you need an app. So I mothballed it and then started developing this app with my great guy in Ukraine, who's a great programmer, company he works for, and started building this app since April last year. And the idea is you have all the news you need. It's not advisory. It's a macro aggregator, I called it. Grimm's macro global aggregator. to condense, hopefully, the most important news in a very digestible way, 24 hours a day, 5 days a week, even on the weekends, on your iPhone. So even if it's locked. So you hear the news first, the squawk. It's a squawk. I work together with Live Squawk, Harry, who introduced us, a great guy. And so we built this together, and it's on your iPhone, on the web, and I copied Bloomberg a bit with this IP chat system. We can also have an individual chat where you can ask questions. We have a discussion forum. So yeah, check it out. I love it. I have my heart into it. And
so it's Grimm's Global Macro Aggregator. Yeah. GGMA. And the way you can go to it is you go to ggma-app.com. Is that correct?
Yeah. Hyphen GGMA hyphen.
Oh, sorry. Yeah, I'm sorry. Hyphen ggma-app.com.
Yeah.
And there's a free trial.
Yes, for 2 weeks.
Yeah.
And then afterwards, if you don't like it, there's still a freemium version, so like a light version.
Okay,
So
there's no obligation. Go, you can get the free trial for a couple of weeks, and then you can always be in the freemium version. Again, it's ggma-app.com, and you can go there. All right. Before we let you go, I have some questions, some personal questions for you that are going to be fun. My wife and I are headed for a hiking trip in the September. We're going to go to do the historic, now I'm going to butcher this, Salza Pensteg, the historic salt trail that winds its way through the Bavarian Alps. Have you heard of this? The salt trail? It ends up in Salzburg.
Salzburg. Yeah. Salzburg is beautiful.
Okay.
Yeah.
So first of all, and then I'm going to be there, and then I'm also going to Switzerland for some stuff. So is there something as a first time visitor to Germany? I've never been. I'm embarrassed to say I've never been to Germany. Flying into Munich. Do you have some must-sees for my wife and I that we need to do?
So Munich is a beautiful city.
Okay.
And then around Munich, there's Neuschwanstein, the big castle. I'm really bad in history there, but I haven't been there either, but I hear a lot of good things. It must be beautiful.
Okay.
Neuschwanstein. But I sent you the link.
Okay.
And you have to have a Bavarian wheat beer.
Oh, is that what they're known for?
Yes, wheat beer.
The wheat beer. Okay. And then when I go, I'm going to be in Zurich. Is there things that we must do in Zurich?
Yeah, you have to meet me first of all, and then I'll show you around.
But what about people that don't have the pleasure to meet you? Do you have something? What's your go-to? When you take somebody out to Zurich, what is your go-to must-visit place?
I love wandering around the old town. It's so beautiful. And of course, Switzerland wasn't affected by the World War, so no destruction. It's really original. Lots of nice restaurants, bars. I love the feeling. And then in the middle of Zurich, you have the lake, which is fantastic. So don't forget your swimming trunks. And then the surroundings of Zurich or Switzerland in general, the mountains. You can go on a hike or go skiing in the winter. It's beautiful. Awesome. It's just beautiful. And the people are very, very nice.
So we're going to end with the question, speaking of nice people, we're going to end with a question about through your career, has there been something that someone did to you that was especially kind, that really helped you out, that stood out that you'd love to share with us? Yeah,
that was my old neighbor. We were 6 years old when we got to know each other because we couldn't remember before. And so I told her about my plans. I was in Munich. I wanted to go abroad. And she passed on the CV to somebody, and because I wanted to go to the Bundesbank, the idea was you go to the Bundesbank, work there for a couple of years, and then have a better chance to go abroad.
Right.
And she told a friend of hers who is a headhunter about this, and she said, "No, you can't do that. It sounds like he's not fitting into the private economy. Wants to become a government employee." So he took on the CV. Passed it on to the local Goldman's branch in Frankfurt. They passed it on to London. I went over there 3 times, 3 days.
Yeah.
First round, I thought, okay, this is nice to be here, but probably not. Second round, okay. And then they invited me the third time, and then I managed to get this job. So basically, this old school friend and very close friend still.
Oh, that's awesome.
She basically, I have to thank her for that.
It was one of those life-changing moments.
Yes,
that
what a coincidence.
Oh, that is awesome.
Yeah.
All right. Before we let you go, let's just plug your product one last time. ggma-app.com. Make sure you guys go check it out. Freemium version and our 2 weeks free trial. Guenter, it's been a real pleasure getting to know you. Thank you very much for your time.
Thank you so much for the opportunity.
Take care. Bye-bye.
Bye-bye.
All right, Patrick, lots going on. Tell us what you see in Talking Charts.
Kev, with the conversation, I don't even know where to start, right? I guess we should start with, as we're recording this, earlier we had the release of the jobs numbers. And I don't think the jobs numbers were that crazy. It was just a small miss on the non-farm. But I think the market just needed a reason to just see a little bit of a relief in the dollar trend and other kind of things that were running hot. And it just so happened that the jobs number gave them a little bit of a push. What did you size up from the jobs numbers?
Well, so the jobs numbers, if we remember back, the past three have been way stronger than expected. This one came in lighter. It also got revised, the previous one lighter. I think it takes a little bit of a pressure off the Fed that is being shifting to hawkish. I noted in my chat this morning, I said, wouldn't it be just like the market gods to make it such just as the Fed gets a little bit hawkish that they go and throw in a weak job number? And that's in fact what we got. I don't know, though, if I would use it as an excuse to explain why the stock market's going down, Patrick. I'll take the other side of that. I think it did.
It just corresponded with it.
I think it was going down anyways. There was some overseas problems. I actually think the meta news is more important than the jobs number. But I do agree with you that it did affect the dollar and make the dollar go off, and it really did help and put a tailwind in gold's back.
All right. Well, listen, I want to talk the S&P. I want to talk all of these markets, but we have to start with the Kospi. Because the South Korean index was and continued to be one of the major bubbles, center points of the AI story. And many have argued that, when Kospi goes, there's a very good chance that it's going to have a contagion effect and take the wind out of the sails in the U.S. and all sorts of international markets that were getting AI tailwind. And what we had overnight in the Kospi was a pretty decisive, peak to trough 2-day drop of almost 12% on the downside. Obviously, on the day, it was just down an 8% gap down on the Kospi. And it was some incredibly heavy selling on both, obviously, SK Hynix. And here's the chart on SK Hynix. Very decisive gap down, just like down 15% on the day. And already almost 30% off its high. And the irony of it is it's 27% off its high, and it's not even testing its 50-day moving average yet. Like it
shows you how overbought it was.
Yeah, exactly. Like the reversion is that dramatic. But even though the SK Hynix was a deeper drop, it hasn't done the technical damage that Samsung does. Samsung went for a double top retest. And this morning's gap down actually got it not only below the 50-day moving average, but did so decisively with a gap down that basically went through a key support line that Samsung and the Kospi in general have been forming. And so these are the types of early signs that the market is transitioning from a prior bull trend to potentially a distribution cycle. And while one day does not make a new trend, and nor do I want to stick my neck out saying I know for sure something is happening, this is not good. Like for the bulls, like this is early signs that some distributions happen. What's interesting is while this was happening at Kospi, on the market open, S&P was up, NASDAQ was up, semiconductors were up, but that didn't last very long. And we find ourselves now with the S&P about 50 points off of its highs, certainly fading a little bit.
By the way, can I just interrupt here and say we're taping this portion on Thursday at noon. So we still don't know what's going to happen the last afternoon. Probably not much because everyone's taking the day off for the afternoon off for July 4th, but we'll see.
We'll see. But nonetheless, the S&P is weakening off of its highs in the hours after this morning's open. And interestingly, like when you look at the semiconductor index, also down 5%. It actually opened up on the morning and now has joined the selling party. So and what's interesting is that the semiconductor breakdown has broken it into a 2-week low at a point where it's now broken the Fibonacci retracement zone, which is typically in a bull market respected. Usually a retracement zone will be bought on dip as there's eager money on the sidelines ready to buy every dip. And the fact that the bulls let it go through a fib zone is just showing that there's becoming more of a balance in supply and demand, and actually arguably even now ample supply up along these levels. And the stock or the ETF is starting to feel some genuine pressure. The big question to ask is that will over the weekend we see some sort of more accelerated or selling on this. One of the big tells to me was Micron. Now, I know you talked the Meta news, which I'm not going to disagree with you, but I think the first warning sign was completely the prairie dog gap on the upside of Micron, and nothing but selling since. And I'm not trying to say that this is going to be the next Oracle. Where remember when Oracle did that huge gap on the upside and then just was relentlessly selling? I mean, this thing had beat on its earnings. Came out with great numbers, goes gapping 15% higher. You know what? This should have been a starting gun for the bulls to go and get another leg in on the upside on the semiconductor index. And instead, the big money sold into the news. And to me, that's showing signs of a heaviness on here. Now, so inevitably this was going to happen, right? Like inevitably when markets get so overextended, mean reversion and reversals of trend are the kind of status quo, or what usually you would end up seeing. But the bigger question to me is that how big of a contagion? Now let's start with a hypothetical scenario. The hypothetical assumption is that was the high of the semiconductors, and some meaningful mean reverting correction, if not even let's call it a cascade versus a crash, so we don't have to sound doomsday-ish, but let's just say semiconductors are correcting. There's some sort of big drop. Can we have a sector rotation that prevents the S&P 500 from drifting down to systematic sell triggers? Or is the semiconductors that big of a trade that they could drag the S&P down and the sector rotation can't keep it elevated, and we're going to see a deeper market correction? What's your first impression when you hear me say that?
I think the S&P is just too tied up in the AI trade. It's going to be tough for the U.S. market to not correct in a AI correction. It's just too much of the index is made up of this trade. Like, do I think that other indexes could do well? The ones that have nothing to do with AI, that have been shunned because people have been, flocking to the AI, for sure. Like the Brazils of the world, maybe the Canadas, even Europe. But
you're talking about international, but how about defensive sectors? Like, obviously, did you see the breakout in the healthcares? Like, look at the healthcares ripping to 52-week highs. Look at the way biotech.
But those aren't going to keep the index up. Is my point.
That's the point I was asking.
Yeah.
It's like, in the end, could there be enough rotation that actually keeps the main index elevated?
No.
Because if the answer is no. Okay.
Yeah.
No, fair enough.
I
You know
just,
what?
I just think it's unfortunate that the AI trade is such a large portion of the S&P, or sorry, of the U.S. stock market. It's going to be very difficult if the AI trade comes unglued
Yes.
for a little bit here for the U.S. to not suffer.
Right.
Now, maybe it doesn't go down and cascade on itself and create, the situation where vol control selling and we get people rushing out and it ends up being
It's
more
going to be
muted.
hard, Kev. It's actually going to be very hard for that not to happen. Well, and I'll explain because if that market correction, like if you recall back in when we had our sessions back in May, all of the systematic trading strategies had a cushion in some cases of 4, even 500 S&P points with vol that would need a realized vol that would have to come in screaming in order for the systematics to flip into sell mode. There's cushion, but when you have an S&P trade sideways like this for months, it's like a trailing stop loss. All of these things become tighter, realized vol becomes closer, the CTA triggers come creeping higher, and what happens is that edge of the cliff is much closer this time around than it was back in May when we had that quick June drop. And this is, so I actually think that this is why I was asking the question, because I honestly think the S&P for those systematic sell triggers to kick in is not that far. Like we're probably, I would argue that it maybe has moved up from 7,300. Maybe it's around 7,350, maybe even 7,400, where you're seeing some of the short-term CTA trigger points starting to come in, and the even medium to longer term ones are not that far behind it. And all you would need is at this point even a 5% market correction. Like a 5% market correction at this point would, from this level right now, would be 7,100. Almost every CTA trigger at this point would be triggered with a 5% market correction. And if that would certainly exacerbate volatility, realized vol control funds would join in, and we'd have some sort of a bigger corrective pattern that may very well get underway. And the whole point here is like, is it that obvious that this could happen here? This is
No,
why
but
I was asking the
yeah,
question.
it's not that obvious, because I would say if you polled most people, the one thing they think can't happen is a major correction in the summer, right? That
my original analog was that it was going to happen in September. So the happening in the summer is the entire thing moving forward, and I'll be quite open about it. Like I am, like when the S&P was at this exact same level back in May, I was hedged almost 2 to 3 times as much as I'm hedged today. And I'm literally now reflecting on, it's like, I'm not ready for this.
Well, because everyone's been lulled into thinking it can't happen. Right? Like, by the way, how many times have you heard these are the best 2 weeks of the year, or seasonally some of the best 2 weeks of the year?
Yeah.
Right. Like we haven't been down over the last 20 years. I think we've had 1 out of 20 that these 2 weeks have gone down. It feels to me like everyone is just like, there's no way it can happen these 2 weeks. It's not going to happen in the summer. Heck, listen, people are more worried about missing the upside than even thinking about the downside, Patrick. This is the first sign of weakness that we've had that's had gotten anyone even contemplating the downside.
I'll tell you, like, this may be on the Kospi. I remember on this episode where I stuck my neck out on whether that was going to be the major Kospi top, and it wasn't, and I was wrong.
I think I did too. I was even more embarrassed than you.
But that, that was back in March, right? When we made that first call on the Kospi top back over here. And it went and corrected sideways. But this arguably, with literally prairie dogging its previous high right over here, and V-shape reversing like this is more evidence that we have seen distribution starting to take control in the Kospi than at any point. Like that quick correction off of an overbought level back in February was in the end just a reverting retracement. But this has almost got the characteristics of a topping formation, and one failed rally will solidify that. Like we just need one squeeze on the upside, failed rally, and this thing is done. And the question then becomes, and by the way, like what's your kind of view? Like my original speculation, let's call it, was that there would be a robust market froth to basically keep things elevated until Anthropic and OpenAI are put out there as IPOs. And so, my original whole thesis was that, that the market was really going to see its more broader selling once we saw the IPOs get absorbed. But like in this scenario, like do they delay the IPO launches if the market starts to sell? Like what happens in this scenario? What would you speculate on what would happen?
Okay, so first of all, I've heard that as well. You'll hear people say something like they won't let the market go down before they get off the Anthropic and the OpenAI, and I'm like, since when do like quote unquote they control it that much? Like that's not the way the markets work. And the reality is that if we look at this, SpaceX realized there was a good market. They came first, they hit the bids. But not only that, we had a situation where Google realized that the world was changing, and they sold the largest secondary in the history of secondaries.
Yeah. Was it 80 billion?
85 billion, I believe, was the number. This was dramatically different. And I wrote that piece that talked about if you looked at share count of all these Mag 7 stocks and you looked at them, part of the bull thesis of the past 10, 20 years has been the declining share counts. And for the first time in ages, we actually have them going the other way. This was a big, big deal.
Yeah, it's like all of these share buybacks. Suddenly maybe we shouldn't have done that, and let's go back and throw the shares back on the market. When the ducks quack, you feed them, right? Like
right. And so the idea that we can say they won't let the market go down until they get off these two IPOs, that there's no precision like that. We don't know how big the mania was. We do know that there was a response from supply. And now we're seeing that response was big enough that it's actually causing the market to hiccup.
I think where I will agree.
1 second, though, can I just finish? Yeah. You asked me, are they going to delay it? I would tell them, no, don't. Hit the bid, right? Like the reality is that these stocks are up a long, long way. I think it's going to be tougher to sell OpenAI in 6 months or a year's time than today. I would hit the bid even though the bid has gone down.
Yeah. So my first of all, I don't buy that camp, and nor would I want to word it that they won't let it down, like it's somebody who's making the choice to do it. But it's generally that the risk appetite is high when there's a lot of excitement around these IPOs that generally allows flows to keep the market buoyant. I don't want to like the idea that there's a puppet master back there and saying I'm not letting it go down. It's just usually the market is very frothy and excited about these kinds of things, and that just generally impacts the sentiment and the flows of people, and it keeps the market elevated. But one scenario that could happen is we go through a very nasty July. Hypothetically, like again, we don't know for sure, but if this Kospi is any warning sign, let's say we go through a nasty July. Let's just go with an assumption it's a 50% retracement. So we go down to 7,000. So we slam down here and we come in here with a 8% market correction. Maybe it's going to be worse, but let's just start off with this thesis. Like it's going to be like a 8 to 10% drop down into the fib retracement zones. And what if there's an appetite to suddenly buy the dip once there's been a bit of a washout and everything? and the market is still maybe not back to previous highs, but starts heading up, where suddenly says that was a big buy on dip. Now it's time for Anthropic and OpenAI. Let's get in. It might still actually work out even with a correction. If the correction is only a short-term, like typical 30-day little drop, the August-September launch of these IPOs could very well still be absorbed near market highs.
I'm not disagreeing there. And then that'll be the next big amount of supply that everyone has to chew through, and that'll probably be the top there, right?
Yeah.
The reality is that, in declining markets, rallies get sold, and I think that would be a situation where there needs to be a lot of supply coming to market, and they wait for a rally, and then they fill that bid. They would, and the real question though is this something we're going to see where it's going to chew through it and then go on to new highs? And I don't think so. I think that there's more and more supply that's going to come on to the market, that this Google wasn't a one-off. And to your point though, Patrick, one of the things you mentioned though, is when you were pushing back on the idea of they control something, I would argue that usually in an IPO cycle, the IPO supply that's coming on the market isn't this size. And I think that's the part that people are just, I don't know, they're numb to.
Have you? Did you go through the exercise? I don't know what it is, and I'm not trying to challenge or test it. Did we like GDP, let's say, adjust or stock market
these are the
capitalization
biggest
adjust?
things by huge.
No,
Right.
like I know, like back in 2020, 21 or 22, when we did all the Airbnbs and all that shit, that Palantirs that came out, that was like 115 billion, and this one's like 300 billion. So 5 years later,
but
it's almost
even
three
market
times
adjusted
larger.
it is. And again,
It's huge. It's huge.
if you read
I'm
the
not
piece,
denying
Patrick, it was there. It was
Sorry?
in there. If you read my piece, it was in there as a market.
Oh, really?
As a percentage of market cap. I'm pretty sure I did it, but maybe I didn't. But yeah.
No, listen. Maybe you did. I just got to do this thing of reading your pieces more often.
Yeah.
It's, I
But the
apologize.
reality is though that this supply situation is way, way bigger than people appreciate. And they think that the world is just the same and that this bull market is intact. And then meanwhile, Google's hitting you with $85 billion of stock. The world's richest man is selling as much as he can, as much as the market. And that's the other thing, Patrick. We are taking these IPOs, and let's remember SpaceX has all those unlocks coming up.
Yeah.
So those unlocks are in essence secondaries, because that's going to be, people have the ability to sell in the open market. So that's going to be more supply coming, to the market. I don't know. I just, listen, I'm pretty bearish. In terms of this, I think that the market is
So
maximum
interesting-
exuberant at the wrong time.
at the time we're recording this, you're not seeing the response in volatility metrics like the VIX. And I'm a little surprised by this. Like with the Kospi making the move it did, with the semiconductors making the move they did, they're down like 5% or more. And with the NASDAQ rolling over, S&P, I get it. It's only 50 points, but the VIX is still a red candle right now. And so right now, at least at
It's
the time
the day
we're
before a
recording
long weekend, though, Patrick.
but maybe that's a gift.
Yeah. Well, I'm not going to disagree with you there. And yeah,
like maybe it's a gift. Maybe the fact that right now, because normally if this was genuinely like a concerning moment, usually that VIX would be 1920 on this first breakdown candle. Like you would immediately have risk premium coming in with some sort of size. Maybe all these traders are out there on the beach planning their little vacation and not paying attention.
maybe most of those guys are like sitting in a van outside the Mediterranean.
Could be. Could be. But
and unhedged. See, that's the problem. You just told me.
Underhedged.
Underhedged. Okay, sorry, not unhedged. Underhedged. Underhedged. This is the problem.
Less hedged.
Yeah, less hedged.
Maybe I'm gonna go. Let's pause the show. Let me quickly go buy some puts
And watch the VIX go bid as Patrick and his minions lift every offer. I can just see all the S&P you got market makers. What is this swarm of vol buyers?
Yeah. Where did this come from?
Yeah.
But nonetheless, it's interesting. I appreciate what you're saying. I agree with it. This Kospi breakdown seems very real, and the fact that the market is weakening off of its highs can't be ignored. All right, let's move on. I want to briefly touch on. By the way, listen, I launched this new site, signal.com.
COT, by the way, COTSIGNAL.com.
The normal word signal. If you don't know how to spell signal, you shouldn't be listening to the show. But COT.
Hey, you're going to get rid of a quarter of our audience with saying stuff like that.
If you don't know how to spell signal,
you definitely shouldn't be hosting it. If you
Anyway, so cotsignal.com. And let's talk actually about S&P positioning on the COT signal. So, well, first of all, one of the cool things that I felt strongly about doing, I worked very hard with one of my market strategist, Masil, over at Big Picture Trading, to build out this COT page. And what I really wanted to accomplish with it was just rethink the way COT reports are presented, because in so many places when I've wanted to go and look at the COT, I'm going to bar charts or some other site, and I'm looking at these.
By the way, sorry to interrupt, but why don't you tell people what COT is? Like, why don't you step back?
It is the Commitment of Traders report.
Okay.
And it's done by the CFTC. And what they do is the Futures Commission requires all participants to reveal what their intentions are with it. Are they a commercial hedger to protect their businesses and forward sell their production or something? Or are they a large speculator like a fund that's built something, or a hedge fund, or CTAs doing systematic strategies? Or is it a small speculator that's just doing such small size that it's not reported as one of the large players? And in the end, they categorize them. And the best part is every week they release the report. So it gives a beautiful release of how everyone is positioned in hindsight. Obviously, they always collect the data for Tuesday and release it on the Friday. It's immediately 3 days old, but it is a window to see how everyone has positioned themselves in the market. Do you want to add to that, or is that
no? I think it's perfect. I just wanted to make sure, because some people might not be familiar with it.
Right. And so this is important because how everyone's positioned reveals where there's stress points, where there's crowding, which can cause squeezes or potential washouts when everyone's trapped in positioning. And so notice here on the first, and what I did with a heat map is I wanted to, first of all, we made it as a percentile of their 52-week look back of where they rank. So that way it oscillates between 0 to 100 on the heat map in terms of a percentile. And it gives us a very quick picture as to see where different assets are at different extremes. So what we can observe when we look at the heat map here, and the first thing that's there is the S&P 500. From a large spec perspective, they're at the 100th percentile as of the June 23rd. Well, obviously this the June 23rd. So we're going to have the new data right now over the weekend. Yeah. So we're going to find out whether that has changed. But it's 100th percentile of the over the last 1 year look back of S&P spec traders. The small speculators are at 80th percentile, and commercials are also at the 100th percentile. It's we inverted this just so that we have this left to right sequence that makes it natural to read in there. So we inverted, but there right now, commercial hedgers are incredibly heavily hedged, and large speculators are at the highest exposure they've had in a year. Right. Now, one of the cool things that we've done is we started tracking the net position divided by the open interest in order to do apples to apples comparison, because over 3 or 5 year look backs, the interest in the market changes and the amount of open interest contract changes, and there's no way of genuinely being able to size how it's comparative unless you normalize it by that open interest.
Yeah, and so many people get this wrong. Like you'll see guys say record amount of short interest in this, and that the reality is in a growing market, you're always going to have records because the market keeps getting bigger, larger, and larger.
It's so how big is it relative to the percentage
of the open interest? Yes.
So this is the interesting part. While it is at the 100th percentile for a 52-week look back in the summer of the fourth quarter of 2024, we actually were at a higher net position of longs, and an even higher one back in February of 2022. So on a 5-year look back, it's not at an extreme. It's just an extreme from a 52-week look back, but it's still at a 52-week high in terms of long speculator positioning. And so over here we have the 52-week positioning score, which basically oscillates between 0% to 100% in terms of their net exposures. And you can see underneath where the equity markets are. The point being, and I like to make this stressed, is that just because a market becomes crowded doesn't make it a contrarian trade to immediately go the opposite direction. Often trades that get crowded or washed out can stay that way for extended periods of time. In itself is not, it's a way I would like to use a nightclub analogy, Kev. So like if a nightclub is empty, and you say observe that it's under-owned, that it's basically under a thing, doesn't mean people will show up and fill the club anytime soon. That club could end up staying empty. At the same time, if you have a super hot club and everyone's piling into there and it's a crowded club, the danger is when there's only one exit door and someone yells fire and everyone's trying to get trampled out. But you could have a situation where the crowd, the nightclub gets packed, everyone's having a great time, but no one yells fire, and
the party just continues, and the cost just keeps going higher and higher.
The point is, I want to make it very clear that anyone using this site, just because you see something at the 100th percentile, do not immediately assume that therefore means you should be a contrarian and immediately short it. It's not, it's not enough evidence alone. What we do is we love using technical analysis, where what we want to see is when the price action is not confirming that consensus view, because then that means a lot of people are going to be wrong. It almost sounds like a Bruce Kovner quote or something.
Yes.
But
guy knows a little something about markets.
Exactly. But in the end, what you're looking for is not when it's super crowded or super washed out, but when the market is telling you something different, when no one is paying attention or everyone's on the wrong side of the trade, because that's when it allows the biggest moves to actually happen. Do you have something to add to that, or does that make sense the way
No, it's great. It's great stuff. Make sure everyone, you go to caughtsignal.com.
Check it out.
It's free.
Thank you.
Yeah.
It's free. And literally no strings attached. Use it, enjoy it, have a great time with the site. It's I want to just make sure everyone has a great window. I think most people hear about COT reports and no one uses them because it seems overwhelming, and a confused mind says no, like when you don't know how to interpret the data. And our goal was to decode this, like literally present it in a way where more people are able to actually interpret the data and have a way of using it to build stories around trades.
Okay. So anyway, do you have any other things in the COT report that you want to highlight?
We do. So we're going to correspond it with some chart stuff. So let's talk about that dollar. On today's jobs report, the dollar was the first to respond with some weakness on here. When we go to the commitment of traders reports under currencies, I click this little button here on currencies. As of last week on the June 23rd, when this was the reporting date, we had pretty much the 100th percentile in the US dollar index right across the board in terms of large specs, small specs, and commercials. Very decisively positioned on that. And currencies like the British pound, 0 percentile right across the board. But pretty much every cross currency has been completely washed out against the US dollar. And so what we've seen here from a positioning perspective is that while the US dollar has made this beautiful breakout, everyone's in on it. Like this is not a secret. Like everyone is now sees the writing on the wall and is more or less already positioned for this. And this to me obviously illustrates that the dollar has room to pause here, but I still, like I was saying earlier with the nightclub, it just might mean the party keeps going. The big tell for me is that will the dip be bought on the dollar? The dollar has established a 15-month trade range that had that 100 level on the Dixie, more or less the top of the 15-month range. And in technical analysis, what was previously resistance often turns into support. So when that area gets tested, that should be where new buyers get attracted. So here we could easily see a 1 full point on the Dixie back down to 100. But what I'm going to be watching is, will it be bought on dip at the 50-day moving average along where these overhead resistance levels now become support? And will that be sort of like a typical retracement point for a bull continuation pattern in the dollar? I'm not ready yet to fade this dollar move, but this is where the big tell will happen. And so this is a level where I'm going to be watching how this plays out.
Okay, what else?
Any comments on the currency?
No, I don't have anything to say. Yeah, the dollar is overbought. Everyone I know is long and expecting it to go higher. And again, it feels like the surprise will be with the dollar selling off.
Actually, you know what? No, we do have to pivot on one currency before I go to the gold.
Okay.
The yen. The yen, 1.5 points today.
You just want to rub it in?
No, it literally
it reversed.
A little,
yeah.
No, not only did, but like there's speculation out there that the Japanese government, Bank of Japan, are going to attempt to intervene here. There was a little bit of a. I don't think there was an actual intervention. I think it was the rumor of an intervention.
They need to do more than intervene, Patrick. They need to do something dramatic.
Something structural.
They need to do like GPIF. They need to change something.
There was Abenomics one time before, but that's not what they need right now.
It's easier to make your currency weaker than it is to make it stronger, and that is the problem here. I've been shocked at the amount of pain that they're willing to sit through, but I guess to some extent it's not pain. It's pain when they're paying for oil and other things but the rest of it, it's all, they're able to sell more of their cars and everything, so they're able to compete against other currencies. And it's really the currencies that are strong that I guess are really feeling the pain from an economic point of view.
So listen, back in like April, May, when that drop happened, I won't lie that I put my toe in the water to mess around to see whether or not some sort of a carry trade unwind kind of scenario could emerge. But the funny thing is, the reason it might work this time is I'm not so interested, and I'm not in it, and I'm not totally interested. So now this is my gift to all of you online. I'm sharing with the fact that, I'm clearly going to get blindsided by this if it happens, because I have this time and I didn't put in my starting position.
And by the way, the Currency Whisperer, I posted this in my chat, and the chat's free. You're welcome to come and see it. I update when the Currency Whisperer reaches out. The Currency Whisperer reached out more than a week ago and said he was buying yen calls.
All right.
Not USD JPY, but like the currency futures. He was betting stronger yen. So he's a wise man, that Currency Whisperer. And the thing is, everyone always wants updates from the Currency Whisperer. It doesn't work that way.
It doesn't work that way.
I need to wait for the Currency Whisperer to reach out to me.
Exactly. Like, you know what? You can't ask. You have to wait.
Yeah.
So when he's ready, he'll tell you. Right. He first puts his positions on.
That's right.
And then knows that we can then move the market for him after.
That's right. Market
He's a smart man, this whisperer.
Moving
how does he whisper the market higher? He gets on the into the ear of the huddle.
He sends the message, sends the smoke screen. The Currency Whisperer loves Japanese yen. Blue Horseshoe loves any kind of steel.
Exactly. So gold, a little bit of an uptick on the dollar weakness. Like it all kind of temporarily kind of look, it's not a reversal. The trend has been awful. This thing is overdue for a bounce, but it is interesting again, looking at commitment of trader positioning on gold. We've actually spent, when I'm just going to go straight, like we're not washed out and under-owned at the moment, but we were for several months down at the 0 percentile of gold. Basically, whatever large specs were in there were more or less washed out. CTAs flipped short, whatever players out there unwound their positions after that. And we're now seeing a little bit of accumulation coming in on the gold markets on here. And so we had the gold and silver markets, I'll quickly show, pretty much washed out for months during this downtrend. And so really at this moment, other than the hardcore bulls that are out there saying, oh, this is definitely the buying opportunity, it has been a vicious 4 or 5 months. And to be honest, this is already meeting the criteria. When we did the blow off top and the retest back in Jan and Feb, I was pretty adamant about the fact you don't have a 2-year bull market and then a correction that ends in 30 days.
Yeah.
There's a symmetry to this. If you have a 2-year run on the upside, there's going to be some sort of a pause and reversion at some juncture. And so at this moment, for us now having corrected from its peak for now almost 6 months, we are now in a territory where enough time has passed and the reversion has been deep enough that if a low came in here, it would technically be reasonably in line with what one would have expected from ebb and flow movement of retracements. Like if I put this on a weekly chart, at this moment, gold has, dropped below its 38% retracement, didn't quite hit its 50% retracement of the weekly chart rally. But like I said, this zigzagging kind of correction down here is already, I would definitely say, the decline is underway, but it feels very 7th, 8th inning, if not already 9th inning. But I'm not going to stick my neck out saying 9th inning yet. But it's late stages. In other words, you're not buying gold anymore at 5,400. You're right now, gold down here 4,000 is probably, you got 10% downside risk. Maybe we go to 3,600, but I mean, that's pretty asymmetric because when gold rips, you've got a 20, 30, 40% upside. For you to have a short-term 10% holding risk is acceptable into some degree or another. Point is, I don't know whether I'm prepared to already say a low is in, but gold's getting washed out. It's already had a long enough time frame of selling. And so at some point, we're going to see a bottom develop here, and it's going to be an asymmetric long.
Got it. All right. What else you got?
We got to talk about this bloodbath in oil.
Oh, yeah. It just keeps bleeding.
But you know what's crazy? What's crazy is that the longs have not been washed out. While we've gotten down, we're going to see the data this weekend. What comes out from the new report? Hopefully,
I'd be shocked if this new one doesn't show them getting washed out.
Yeah, I wouldn't be shocked too.
And the other thing is, you got to use Brent as well.
Yeah, this is CL. Yeah. But point being here though is that we obviously were at the 100th percentile during that March peak, and we've worked our way down, but nowhere near washed out like we were in 2025 on the downside of crude positioning. And so right now, no matter how painful, like this is like literally we can write a textbook on the pain trade using this oil contract. It literally, because it was genuine fundamental reason why oil was higher. They're literally, oil inventories around the world were being depleted. You basically had this trader hormones closed, tank bottoms on Cushing, and other things like this happening, and so you have all of these things happening. There was in any rational macro strategist's mind, this is a once in a lifetime moment that you see in crude oil. How can it not result in oil prices remaining high? And the problem is that was a very consensus view. And to be honest, in many ways, I can't find, like, I remain long some crude oil, and painfully, including some hedges, but didn't hedge as much as I wanted them to. But, I am like, well, look, an oversold market like this will inevitably fib retrace or bounce. It's going to come and find a new fair value. So I can't find anyone who disagrees with me other than I think I read Doomberg or something that was basically a little more bearish. But I can't.
You're saying that you don't know any bears? Oh, you're talking to too much of your that show you cheat on me with.
Really?
It's your crowd's all the same, because I know nothing but oil bears now.
Really?
Like, yes, like I know the
Thank you.
occasional guy that's like, Paolo Macro is a good pal, and like, so obviously he's bullish, and I know a couple bulls, but on the whole, when I go look at what I'm reading and stuff, there is way more folks calling for $50 oil than there are guys calling for $100 oil.
Really? Okay.
Yeah. So
All right.
to me, I feel, and not only that, Patrick, you admitted you're long. Almost nobody's willing to do that. Like I wrote it up because I feel like everyone was puking.
Let me show you my scars. Look at the scars.
Well, at least you have scars. I'm missing toes and fingers. But no,
it caused my biggest drawdown in years, dude. Like it's a lot of guys that were puking that out. I bought a lot of the people that were puking. Like I only bought a week ago or whatever it was, a week and a half ago. So for me, I'm offside like maybe $5. I don't even know if the stocks are offside versus where I bought them. Because I actually like the stocks, but I still think this is just noise. And that at the end of the day, Patrick, the surprise was how malleable the oil system was, how much SPRs there were out there, right? Yeah. And how much they were able to fill that and that we didn't hit tank bottoms like everyone said. That was the surprise. But the long and short of it is we still emptied SPRs like we've never emptied SPRs before. Like even now, I believe we're still emptying the SPR, right? Like think about that. We're emptying the SPR into these prices. And so my point is that on the other side of this, we're going to actually have to fill those SPRs. So the surprise was, on the one hand, that it didn't go up to 200 like everyone thought. I still think that the surprise on the other side is going to be that the SPRs remain bid forever. And to that note, Patrick, it's not just filling the SPRs back to where they used to be. It's also the fact that people are now going to say, I need a bigger SPR because I've realized now that the world is not as safe and is as stable as I thought it was. And so I one of my good subscribers, buddy, he just sent me the article about the Indians, filling their SPR. They've tripled the size of it. And that's going to be on the bid forever and ever and ever. So yeah, we can sit here and argue about the squiggles, but I still think that from a bigger, longer term perspective, there's going to be structural demand on the other side. And the only reason we haven't seen that yet is because we're still emptying the SPRs. Yeah. And that the real trade is to play for the SPR refilling. That's how I view it. Well, you know what, that's just, you have to make sure that you have the right time box for that, like the duration, because like in the end, like what surprised me the most is that usually, like as an example, look at this sell off over here. After several weeks of dramatic selling, there comes the elasticity of the snapback rallies, and oil is notorious for these violent swings down, wash people out, and violent swings back up. But this has been a relentless bid.
Relentless offer, you mean?
Yeah, offer.
Yeah,
hitting the bid each time.
Yeah, because it's the SPRs, just emptying it, and just filling it. Not only that, there's all sorts of wild stuff going on the crack spreads, and this is like this story's not over. Everyone, all the oil bears, the guys that say you should never, go against Trump. He's won again. Let's see where we are in 6 months, because I'm still worried that this isn't over by any means. And I'm not rooting for oil to go up, because that's the other thing about this. It's a terrible position to have, because like the reality is that the world's a worse place with oil higher. Like we should want oil lower. Everyone's like, if oil goes up to $200, it's going to be problems throughout the world. Yeah. So like that's the shitty thing about having that position. But having said that, I do just think people are way too complacent about this, and that this SPR bid on the other side, I don't even know if you need the SPR bid. I think you just need the SPRs to stop selling, and we probably have this thing go bid.
It's true. Like I'm not going to say anything else. I agree.
Okay.
On that. I wanted to wrap up with just quickly touching on copper here. And this is the most interesting for me, because this is really tests this COT report stuff really well. We had a very consensus positioning to max long on copper. Now we're at the 80th percentile right now, but we were at the 100th percentile just last week. And we basically had copper at not only a 1-year high, but you have to go all the way back to 2020 into 21 to see a net positioning as a function of open interest that was as high as it is. Again, to the point, crowded trade does not mean it's over right away. It just shows that there's a lot of people that are structurally bullish copper and are looking for this trade to work. And what's interesting is that this is really the key test. When you have this type of a retracement, as you see here, copper doing a 50% retracement, this is where, if the bull party is going to continue and this crowding is proven correct, we should reclaim that 50-period moving average. We should see this thing back above 640 towards 650 within a week or two, and then take a stab at 7.25 on the upside. This is still possible. The bulls are still in control. This chart is still got the characteristics of higher highs, higher lows, fib retracements, and everything. But this is actually a key moment, because the trade is very crowded, and if copper fails to confirm that the bulls are in control and make these breakouts, then there could be a lot of velocity to the downside if there's an unwind. And so this is one where I would stay long copper, but I think if there was ever a time to own hedges and protecting your copper positions, it's now. That's why you got
to go to cotsignal.com.
Thank you, Kev, for the play. But it is really interesting, but that's one of my covers. There's something a chart you wanted to look at?
Nah, I got nothing else.
Well, listen, I'm going to be doing an update every single week on YouTube on the COT report. So if anyone wants to just see what I'm seeing changes week over week and bringing things up into thing, you can see right here on the right-hand side is a YouTube video that will be updated weekly after the COT reports are released. I'm just going to go through the heat maps and show the key changes and highlight what's going on, so you can check that out.
And he promises to smoke no cigars.
Yes, Kevin. That was a phase.
It was a phase.
Oh my God. All right. That's it.
All right.
No more.
So listen, first of all, happy Canada Day to all our Canadian listeners. And happy July 4th to all of our American listeners. This is a big one, I hear.
Mm-hmm.
250.
Rumor has it.
Yeah, rumor has it. Enjoy yourself. Have a terrific weekend. Listen, bear market, bull market. Oh, I should tell people, where can they find more about you and your terrific service, Patrick?
You can find me at bigpicturetrading.com, but check out the cotsignal.com page. And Kev, where can they find you?
I go to the macrotourist.com. And by the way, if you're watching this on YouTube, make sure you subscribe, but don't just subscribe. Click on that thing and hit all instead of personalize. Listen, bear market, bull market, we're just happy to spend some time. Thank you for tuning in. Have a wonderful long weekend. Now stick around for the after show. Here comes Danny.
I'm not even going to rate this beer because I've had it numerous times on the show. Every time I'm
you know what?
Spain,
I think you should rate it, and then people should tell you how the distribution of your returns in terms of how much it's like.
Shit, I don't even know what I rated last time.
I know. Well, that's what we can figure it out. And Danny, what are you up to,
I'm
buddy?
giving it. I'm going to give it a
Okay.
7.1, just so that people can call me out if they.
It's probably going to be higher before.
It's a good drinkable beer on a nice hot sunny day.
Well, Danny was giving you a lesson in Spanish. What is it? 2 L's, 2 I's? What is it? Sound like
Two
a
L's.
what?
2 L's is a Y.
2 L's is a Y. Coming from the
Yeah.
Englishman.
Absolutely.
Exactly.
Unless. But not for the Portuguese, because when we were saying that, like most Portuguese will say Seville, and Spanish will say Sevilla for the city. Like the Portuguese will still pronounce it with the L's.
By the way,
And,
Patrick. Sorry. Finish up. Sorry.
No, I'm just saying.
I was going to. Yeah. So obviously the
I'm
Portuguese.
turning Portuguese is basically what's happening.
So speaking of Portuguese, big game tonight in Toronto.
Yeah.
Portugal versus Croatia. And we
Oh,
have
is that tonight?
Tonight in Toronto, 7 p.m. And we have huge communities both in Toronto.
Yes.
So
Wow.
everyone's joking that this is like the Catholic school nightmare, finals.
Well, we'll see whether there's riots on the streets. In Toronto.
I don't know which community would be larger in terms of Torontonians, but it's going to be a huge game, and it's really hot. Like, it's stupid hot here.
No, but you know what? The Portuguese community is huge in Toronto. When I was in grade school in north of Toronto, I was in a class that literally 50% of the class was Portuguese.
Come on. Why? Where you say north of Toronto? Where were you growing up?
In that time, it was in Bradford.
Bradford, like home of Wayne Gretzky, Bradford?
No, that's Brantford. Bradford's halfway up to Barrie.
Oh,
right up there. But anyway, point is like literally half the class was Portuguese. Like there was, I was in like the heart of the, and here I am living in Portugal. Right?
You just loved it. It just rubbed off on you. By the way, did
off.
you know that a lot of Torontonian Portuguese people are actually from the Azores?
Yes, yes.
Yeah.
Basically, you're halfway across the ocean anyway.
They were just like, screw it, let's keep going. And then, where should we go? And little did they know they were coming to a place that's going to be
But it is a
stupid
beautiful island. I like now that,
I haven't been to the Azores. Have you been to the Azores as well?
Yeah, I've been twice, and I've been in Madeira now 4 times. Like beautiful islands, just stunning, beautiful places to visit.
Wonderful people. So who are you going to root for? Portugal. I guess you got to root for Portugal versus Croatia. You got to vote. Portugal.
I got to vote for a thing, but 2 of my best friends are Croatian, and so this is a very heated kind of moment. But you know what? I'm living in Portugal. I would love to see Portugal go, because I literally will drive back to Lisbon on July 19th to be there if they go into the finals, just to think. Like, I was planning on being across Europe, but I'll drive back for that. Like,
so listen, we got to talk about Danny's team. You got this guy I didn't understand. There was these keen jokes and I didn't understand them and then I finally figured it out and stuff like that. Tell us about your team. Do they have a chance? What's going on? I think that they have trouble in the heat, right? Like, this isn't very good for them, this heat wave.
Look. Right. I'm going to put something out quite clearly here. Like, you can see that you can't. England always do this. They start strong.
Yeah.
Everybody gets really like, wow, this is the one, guys. This is the one.
Yeah.
And then you'll slowly start to see how bad they just become very, very, very slowly. And to be quite honest, I think we're already at that point where I'm like, I think you've got maybe 1 or 2 matches, and then it's not going to do well. That's it.
He's like a Maple Leaf fan, and he's sort of hope has been beaten out of him. When was the last time when we talked about this? You guys won like in the 60s or something? It was a long time ago.
When was the last time England?
Yeah, that was that stupid goal you cheated and it didn't even go in, or it did go in. I can't remember, but
I mean, that sounds right.
Now, did you guys? Oh, did we talk about this? The Scots came and drank all the beer in Boston.
Oh, that sounds right. Though.
Did you know that they literally came and they drank all the beer in Boston? Like they ran out of beer, and it was so bad. The one guy was like, "Yeah, all they had was, in his Scottish accent, he said like all they had was Bud Light. We're not drinking that."
Right now,
Rightfully so.
The last time
ahead,
England won was 1966.
Wow,
60 years ago. Is it 60 years?
yeah, you got it, but good with the math. That would be.
So there's a very famous song with the "It's Coming Home," right? And in that song, they said 30 years of hurt, but now it's 60 years. So
No, when not Boris, when Beckham was on the team, did you guys get close?
Yeah, I think it was like the 1997 World Cup. I remember being 7 years old, and I remember we were close. I remember it was this whole hype around it. But since then, it really is just. There's not even any point really. You might as well just root for another team, which is exactly what I'm doing. I'm hoping Portugal do pretty well. So.
A true English fan. He's completely given up. He's just like, fuck it, they're gonna lose anyway.
Yeah,
you watch, buddy. This will be the year.
How about Canada doing well?
Yeah.
I did not expect that. I was not following Canada at all.
Yeah, we have some decent players. Like I think one of our main guys is hurt too. Like we have some guys that are playing like they're actually good. It's not like France where everyone is like on, winning this, winning that, or whatever. But we have some decent players.
Yeah.
Wouldn't it be hilarious? Because we lost hockey, and that's like in Canada, literally you get a silver in hockey, and it's like, what the hell? You guys got a silver? Like, there's this one great picture of this woman on the women's team, because I think we lost on both. I think we got silver on both. And this woman looking at her silver medal with the biggest look of disgust she's ever had. And so wouldn't it be hilarious if Canada just all of a sudden did I think we're like less than a 1% chance, so we're not going to win. But wouldn't it be hilarious if we actually went far in soccer? And everyone's like, oh, look at that.
The funny thing, the fact that you've just brought that up, actually, and I think we've forgotten this, but the women's England team actually won the Euros. I think it was I'm looking at it now, because don't fact check me, but I think it was in 2022, and they won.
Oh, there you go. But that's the Euros. That's not the FIFA. Or that's not the World Cup.
The fact that we won something is, it's pretty special.
Okay, that's good. I mean, take that away from you.
So, but you know what? Like Canada is playing Morocco, and you know what? Morocco's been playing great.
Yeah.
But it's not that crazy for them, to be able to.
But I think the next round is France, though.
Yeah, then that would be France, Paraguay. That would be the challenge, right? Like that
that would be the slaughter. Isn't France going to win it all? Isn't France the favorite?
Yes, that's the favorite for sure. Yeah.
Yeah, France
Mbappe or whatever.
Always very good.
Yeah, I love that the Italians didn't make it, and when you talk to an Italian, they pretend like it doesn't even exist. FIFA?
Yeah,
what's that?
They're like, what's that?
It's dead to me.
I literally went to a hedge fund dinner, and it was like 3 or 4 Italian dudes, and they were just livid that their team didn't make it. Like, it was just wild seeing how upset they were about this. It's just this was a huge deal. I take it they're ninth, like in terms of their seeding. I don't really know, but somehow they missed the I don't know. I don't really understand the whole thing. I don't even know how they picked.
They were
them.
probably just drinking cappuccinos or some Aperol Spritz and forgot.
Because not only that, this was an extended. This one was bigger than most FIFAs, right? Or the most World Cups, because we added a whole 16 teams, I think. This is the largest one ever.
Well, I guess so. Actually, I think you're right there. I don't.
Yeah, because people are being
figures,
complaining that the quality sucks because there's been teams that really shouldn't be in there.
I mean, you say that, but then England still sucks. So I
Okay. Well, anyways, we'll let you guys go and have a nice swim in the Mediterranean or whatever you guys are doing, you bastards.
It's he's in the Atlantic. I'm in the Mediterranean. So,
Okay,
but swimming nonetheless.
Okay. Well, have a terrific time. Happy Canada Day. Happy 4th of July to everyone. Thanks for tuning in, and we'll see you in a couple of weeks' time. Take care.
Cheers, everyone.